What's going on, everybody? My name is Noah. Welcome to another episode of Systematic Investing. And today, actually, before we get going, you see the disclaimer down the bottom. Do your own goddamn research, or else Santa's gonna come put coal in your stocking. So you better get on that. All right. Today we're gonna be talking about Applied Digital, aka APLD. It's been kind of hot stock on a bunch of forums and stuff recently, and I decided, you know what, I'm gonna go take a look at it. So first off, let's get into what Applied Digital actually does. So they have three lines of business. They have data center hosting, so they build data centers and lease them out to companies to fill them up with equipment and then operate them. And they have cloud GPU leasing, which is their company like sub companies called Side Computing, but built out of data center using Applied Digital's hardware. So they make a data center, fill it with their own GPUs that they get from NVIDIA, and then they lease out the power to customers, similar to what CoreWeave does. And then they have this long-term contract they just got with CoreWeave, which is basically CoreWeave. Uh, let's backtrack a little bit. Applied Digital builds a data center, gets power for the data center, and then CoreWeave is willing to pay $11 billion over 15 years, and it's going to end up being three different data centers that they're going to scale into over the next 3 years. So yeah, they got a 15-year lease, $11 billion, and so honestly, it's possible that other CoreWeave kind of companies they come in and also get more of the same deals going. So there are two major data center sites are up in North Dakota. It's the Ellendale is one of them, and then Jamestown's the other one, North Dakota. And they do it because they get really cheap power. If I'm not mistaken, I think it's 4 cents a kilowatt hour, which nationwide average is 13. And they also, North Dakota's windy and cold, so GPUs make a ton of heat. So you get natural cooling from airflow. So you get air cooling plus the liquid cooling in the GPU racks, which is awesome. And then so first we'll go over each of the businesses. So the data center hosting business, they build the data center, operate it, and then they operate the overhead, and then the customer will come in, put their own shit in there, and then most of those are crypto mining customers, and then Applied Digital will charge them a fixed price per megawatt hour, and then that's where they get their revenue off of. So their gross margins on that are about 25 to 35%, and they do about $150 million a year in that, and it gets stable cash flow, super stable business. They've done it for a few years now. And then they have the digital cloud, which is one I like a lot because it's just really scalable and the demand is just through the roof. So they use like A100s, H100s, and then they build and operate their data center, then fill it with their own GPUs that they buy, and then they lease out the computing power to people trying to train AI models. So in fiscal year 2025, they did about 30 million. It's not over yet, but they're going to end up about 30 million. But the gross margins are about 60 to 75%, and they get a lot of leverage off that, scalable, and it's recurring because they just get customers more and more and more and more and more, and more computing power is what's needed. But it is pretty uncertain for the future because I read their last earnings presentation and they had like two slides about it, and they're kind of just like, yeah, this is what we do, and then just moved on. They barely talked about it at all, which honestly, in my eyes, what I see possible is that they might get acquired, Sci Computing that is, and they might get acquired, or somebody's going to come in and buy a huge stake of it, or they could always spin off the company with Applied Digital holding a majority of the shares, IPO or something like that down the line. So who knows what they're going to do with that? And they mentioned that in the earnings call too. They're kind of like, well, we're weighing our options with that. So we're gonna see what happens with this one. I'm most excited about this, so I'm really gonna be basing everything upon this. If this falls apart and doesn't go through, I'm gonna be a little sketched out, honestly. That's kind of a risk here, but so the CoreWeave deal, as we mentioned before, $11 billion contract over 15 years. So there's a 300 megawatt capacity target by 2027, which is 7 billion of the 7 billion over 15 years. And then they had an option to extend it to another 150 megawatt building in 2028. And CoreWeave recently just said, yeah, we want it. So about $730 million a year once it's fully ramped. And obviously, CoreWeave being a big deal in the what we call it computing leasing space for AI training. I mean, that's a huge tenant to have. They're not going anywhere, so that's awesome to have for them. And then, so the data center hosting kind of provides stability and cash flow. You get that $150 million a year to make some money on that. So that's going to help them spend more capex to expand. And then the Applied Digital Cloud, also if they have extra space in one of their centers, then they can just put a bunch of GPUs in it, lease out computing power. So it's really good for their flexibility. Like I said before, high margins, they can actually make a lot of money off that. And then the CoreWeave deal, obviously going from $150 million a year in revenue to 730 just off that deal, plus the 150 they had before. I mean, that's 6x revenue just off that one deal. So, I mean, that's huge for them, and that's going to be a predictable growth driver going forward. And then, so as far as the risks, they have execution risk is by far the biggest risk at this moment. So, say that they're targeting 2026, 7, and 8 for their three centers for CoreWeave. Say the first one gets delayed to 27, then the second one to 29, and the third one to 31. That's going to cost them a ton of money because, I mean, as the construction project lags on, people still getting paid. Everything's just going to keep costing, running up money. And that kind of brings in the second risk, which kind of runs off of the first one, just share dilution risk. If that happens too, especially, they're gonna have to dilute shares more, which is gonna obviously affect the stock price. And it's just gonna increase share count, dilute. It obviously isn't really good just for doing something you were already gonna do anyways. And then the third risk is if somehow computing power demand for AI applications could decrease over time, resulting in fewer opportunities in the market. But realistically, between here and 2030, really unlikely. I mean, with Meta going 80 billion, like the total capex on AI infrastructure is in the over $200 billion. So there's tons of market for them. So now we're going to get on our valuation. So base case here, we did 140 in 2024, saying about 190 for year 2025. They use a really wacky fiscal year, so this was kind of a pain in the ass to get going. But in 2026, the first CoreWeave thing's supposed to come online, so we go 120% up to 415 million in revenue. Then 2027, another one comes online, so we go to 665, and then 2028, the third one should theoretically come on. Which I honestly I think that they're going to get it done, but so then we get to about a billion by 2028. And then 2029, 2030, 31, I just threw 30% because I assume, honestly, that they're going to continue to get more clients and they're going to be able to, one, expand the applied digital cloud, which I mentioned before. If we have some sort of spin off or they just kind of scrap the business altogether, that's going to be a huge risk to this whole valuation. This won't even really matter, honestly. It's going to be notably lower than this. But I assume in this that they reach 100 million a year in 2028 and 250 in 2030, and that the crypto mining business just keeps doing 150. They don't invest or grow in it at all. And then, so that's going to get us 2031 revenue of about $2.2 billion, which is huge considering we're at 140. It's 20x in 5 years. So we'll see if they can do that. But I think they can, based on what they have going, especially with the CoreWeave deal. Then we're running net margins of 10%, low margin business, you're operating data centers. So that gives us 219 million, and with a 60 PE because they're going to be growing at 30% revenue. I mean, that's totally fair in the AI space. And then that's 13 billion market cap, and the shares outstanding, that's about a 15% expansion from our current spot. So that'll give us a target price of 52 and 17 based on our 25 discount rate. And then over on the price of sales, we go 8 price of sales, which gives us about 17 billion market cap, 70 and discount 25, 23. So our overall price target is $20 for 2025. So about 30% undervalued at the moment, according to this, and 61 for the future. So from there to now, it's about 4 times in 5 years, which is fairly good risk reward proposition there. So now we're going to look if in our second bull case, I don't really want to do a bear case for this because the bear case is basically that it's down 80%. It's screwed. Like if they can't execute on this and they have to dilute shares a bunch, they screw up the core deal. Like this whole thing's completely chalked. Like it doesn't even really no point even doing the math. $2 a share probably. So we're gonna go to our bull case here. So I assume in this bull case that essentially over here on the right we have assumptions. Just kind of highlight that there. So the core deal will get the 460 by 27. They get everything on time with the core deal, same as the base case. And then I assume 150 or 100 to 150 by 2028 for the applied digital cloud. And I'm looking at $1 billion in annual revenue by 2030. So this case kind of assumes that the applied digital cloud really takes off and customers are asking more and more and more. So then once we get the core deal fully in, we're going at 50% growth and before that as well. So that'll get us to about, in 2031, about $3.8 billion in revenue. And then with that applied digital cloud being a higher percentage of revenue, that'll bump net margin up to 15%. We're on a 70 multiple on that, and then we will go 40 billion market cap. I kind of stuck with the same shares outstanding because all the capex they're probably going to dilute a little bit in the next couple of years, and then that gives us 159. Then take off the discount rate, 52 current value, and then for price sales go about 12, which I think is totally fair for an AI company who's in data infrastructure, especially one that's garnering interest amongst the community. Honestly, right now it's 23, so it could obviously always be way higher than that or way lower than that. But this is kind of just a rough estimate here. And then obviously shares are staying the same on this side. Then we got 182 and 59. So that brings our overall bull case price target to 170 with a current value of $56 a share. So with that said, that kind of gives us really high upside, assuming they can execute. If they execute really well, upside's high. They don't execute, no upside, quite negative upside. So this is kind of like a high risk, high reward kind of deal. So I mean that's 10x or it's basically 10x or bust at this point. So overall, just in conclusion, it just has asymmetric upside. The downside risk meaning they can't execute effectively, and they have a great infrastructure and system to scale over time. Obviously, a possible 5 to 10x share price by 2030. And honestly, what I would say here is under $15, it's definitely worth allocating a little bit to the stock just due to the asymmetric upside and the business that they're in. I mean, when you're just filling data centers with AI server racks in this day and age, that's just a really, really powerful business. So, with that said, guys, thanks for tuning in. Like and subscribe. If you got like any, you know, recommendations for me, how I can make these videos better, more entertaining, I'm gonna come out next week. I'm gonna make a video about housing and why housing at this current point in time could be a catastrophic investment going forward. So thanks for tuning in, guys, and I will see you next time.